Yesterday, obviously, as we've mentioned, we saw the central bank keeping rates unchanged. Do you think that we are going to see a rate cut perhaps if this shilling strength to the euro continues?
Basically, what I believe will happen is one, many analysts, including me, are just wondering on, what's the formula the central bank actually uses to calculate the rate, because at the end of the day, whether they cut it down or increase it seems to have no effect on the market. And at the end of the day, the stakeholders in the banking industry will listen to what central bank has to say and then continue the business. And despite the fact that the shilling has hit its lowest point in the last in the last 1 year, whatever happens with the rate, according to central bank, I believe will have no impact or effect at all on the market until and unless central bank actually comes out and explains on how, one, they actually calculate the formula, and two, they're able to take into account the issues raised by the commercial banks, because at the end of the day, the lending rates for the commercial banks to consumers is still high, and despite the fact that most of them have reduced this. And secondly, at the end of the day, for such a regulator to issue out policy issues that are not taken seriously by stakeholders brings into question of exactly what's really happening in the market.
But if the central bank is coming out with this decision and they're not being taken seriously by investors, what kind of recourse does the market actually have?
Now, that's an interesting question, because one, what I know is what's been happening is the commercial banks have raised their own concerns, especially when it comes to the aspects of lending and liquidity. And what I know is in the last 2 years, when the economy of Kenya has actually been in the doldrums because of what we've been experiencing, drought, post-election violence, and basically the world economic crisis that's been going on, I believe what the banks have come up with, their own private measures to actually try and control the issues, especially in terms of lending to private businesses and consumers, by coming up with more terms and conditions before they actually get access to funding, and basically asking the central bank to increase liquidity in the market. But given the fact that while we're watching what's happening in the European markets with the euro actually weakening and the dollar becoming more stronger, making the shilling weak, I believe the stakeholders and the regulator need to sit down and actually make to understand how central bank comes up with the formula to arrive at these rates.
Because last year we also saw a change in the inflation calculation as well. What is the likelihood that there could be a change in the way that the lending rate is calculated? An
interesting question, because when they change how they calculate the inflation rate, many people, like at the moment, if you tell someone that the inflation rate is on a single digit, they think the economy has improved and things, the consumer should actually be having an easy way in terms of purchase power. But unfortunately, it's not like that. When you're looking at the 190, the ordinary person's economy, life is pretty expensive. Inflation is still high. Basic needs in terms of commodities, food, and healthcare are still high. So central bank needs to actually come out clearly to explain to us in layman terms on how they're actually arriving at this. And from what I know, central bank, according to them, they said the lending rate is okay, the economy is strong, the stimulus package that was given by the government is actually being implemented. So they see no need to actually cut it more or increase it further. So I see them not coming out to explain how this formula is actually arrived at, which will mean that the stakeholders in the financial and the commercial banking sector will continue doing their own ways to actually try and see how they can survive in the market.
Mm-hmm. A very interesting discussion, Steve. I just wanted to get your view on a stock that we don't often cover here on Street Talk, which is EGADS, in terms of an alternative investment case. Yesterday we saw that stock increasing by 9%. It is an agricultural stock. What is the story behind this stock? Is it something that investors are now looking at or at the moment?
Agricultural stocks for the last quarter have actually been a darling of many investors, because one, the weather has actually improved significantly. Two, the government has given a lot of focus into the agricultural sector, giving them stimulus packages and incentives. We've also seen the financial sector through banks like Equity, pumping in a lot of money to help the agricultural sector actually pick up. And EGADS is one of the stocks that many investors have been looking at, and I believe especially for the last 1 week, with the speculation of a 62% buyout, by an international investor. We've seen that the stock, which has had little liquidity in terms of share movement, has really picked up, going up at least 5% minimum, and I think it's still going to rise up. I believe it's a stock to watch, especially now that if the buyout deal goes through and it's approved by the regulator, it's a stock that will actually be interesting to look at. And the weather seems to be improving better, with many agricultural farms actually diversifying their products and services.